Hi. Um, okay, let's get started. Okay, you guys you can see my screen, right? In the PowerPoints, right?
Yep.
Okay, that's great. Go back to the. Okay, just summarize. Okay, so what we learned previously. So we spent two lectures, right, on these called the temporary differences, right? Because in US we have two systems, right? One is the accounting, one is a tax. Okay, the two system, and there's a lot of similarity and there is always a lot of differences. Okay, that's why accounting income usually is not the same amount with the taxable income. Okay, so we talk about this temporary differences and two situations. One is the accounting income is greater than taxable income. Okay, so accounting income greater than taxable income, this situation, right? So let's say accounting income is 100, taxable income is only 80, right? So then profit this year is 100, but we only pay tax on 80 of those. So therefore we have 20, right? Those tax will not be paid today, I mean this year, but will be paid in the future. Okay, so we'll pay the tax on this 20 in the future. The tax on the 80 is due right now, right? So that's what we call the 20 is the future taxable amount. Future taxable amount will be, we will pay tax on the 20 in the future. So then we have obligation to pay tax in the future, right? So the obligation is called a deferred tax liability. So let's say in the future, tax rate is 20%, right? So then you got a four, right? So that $4 should be our liability. We call deferred tax liabilities. And then we also talk about the the situation here. So the accounting income is less than taxable income. So let's say the accounting income is 100, right? So but taxable income is 120. Okay, what do we do here? So we made profit 100, but we pay tax on 120. It seems not fair, but because we paid more taxes right now, so in the future we can deduct that 20s, okay, in the future. So that's what we call the future. This 20 is called the future deductible amounts. Okay, so basically we have what in the future we're gonna pay less tax, so we have a tax benefit. So that's the future benefit. We call that deferred tax assets. Similarly, let's say 20% of the tax rate, then 20 times 20%. So that will be 4, right? So you got a 4 will be our deferred tax assets. Okay, so those are two situations we learned. Okay, and then this is a summary. Okay, this is a summary what we have, right? So we talk about these two, the purple colors here are the situation deferred tax liability gonna have. Okay, because those two situations, our pre-tax accounting income is greater than taxable income. Okay, so we had the example, right? We talk about those for this example. We also talk about this. Okay, so you're gonna see some other example in your homework questions on in the future, our example in class. So this is the deferred tax liability situation, and then the blue colors here is the deferred tax assets, because in those two situations, our taxable income is greater than accounting income. Okay, so we paid more tax relatively in this year. So in the future, we're gonna pay less tax. So we have a future deductible amounts. Okay, and then we have deferred tax assets. Okay, so we talk about this situation, right? Subscription, marketing subscription, right? Um, we talk about the estimated expenses, like warranty expenses, right? So those situations we use as an example. Okay. So then other things like similar to that. So those are the what we learned. And then regarding the deferred tax assets, these are the future benefit for some reasons or some situation. a manager needs to assess, right? So you need to ask yourself, if we're gonna realize those benefits or not. Okay, if some benefit cannot be realized, then you need to make adjustment. Okay, you call that valuation allowance. Okay, so those are things we learned. I need to go. Those are things we learned so far. Okay, and today we're gonna talk about this so-called permanent differences. Okay, the permanent differences. So the previously are the temporary differences. Those are temporary, we said, because this is the timing differences. Over a period of time, there's no differences at all. Okay, over several years, there's no differences at all. Okay, so but some differences are permanent. Okay, so they're permanently different between those two systems. Okay, so then this permanent differences is much easier than temporary differences. Okay, let me show you the example how to deal with this. Okay, so this is the company this year 2016. Our pre-tax accounting income is 145, and then we have one permanent difference. Okay, so we call the municipal bond interest. Municipal bond interest is the interest received when you invest a municipal bond. Municipal bond is a local government bond. Okay, it's local government bonds. Let's say we are local government issue bonds. Okay, so then let's say we're as a company we invest that bonds, right? So for us, this is our long-term investment, right? And then we're gonna periodically receive the interest, right? So when we receive interest, we call that interest revenue. Okay, so in accounting, we recognize those interest revenue as one of the revenues, right? So that increase our pre-tax accounting income. Okay, so part of the pre-tax accounting income, 145, gonna include that 5, right? So 5 is the interest revenues. Okay, so it's interest income from that investment. Okay, that's why part of this 145, 5 is it comes from the interest. Okay, from that investment. This is accounting, but tax code said if you invest in the municipal bond, your interest gonna be tax free. Will be tax free forever. Okay, uh, the interest will be tax free forever. Okay, so okay, so that is the permanent difference, right? Because in accounting, we need to recognize this as one of our income, right? One of our revenues. So that included in 145. This 5 is included 145. Without 5, it should be 140, right? We include that 5 as one of the pre-tax accounting income, okay? Because this is one of the revenues, interest revenue. But we're never gonna pay tax, okay? So we will never pay tax on this 5. Okay, that's why taxable income should be what? You should exclude that, right? So 145, okay, exclude this 5, then you have 140, right? 140, okay, that will be taxable. And in this case, we also have another temporary difference. Okay, we have this installment income, okay, installment sales. This is the example which is comes from the very similar copied from the first example we had. Okay, so that's installment sales. So we sold, okay, remember that's like a piece of land, right? We sold a piece of land and total is $40 million. And then this is the installment sales. We're gonna receive the payments next year 10 millions, and next year 30 millions, right? So this is the installment sales, okay, situation. So and that installment sales, the temporary differences, right? So for the initial year 2016, Okay, 2016. Remember that installment sales going to be recognized as one of the accounting revenues, right? One of accounting revenues. So this is the full 140 here. That include that 40s, right? Include that 40s. Okay, so as one of the installment sales. Okay, so then the remaining is 100, right? So like that. So but on the tax returns, remember tax returns, we don't pay tax on that 40 because we haven't received the payment yet. Okay, tax code, we pay tax when we receive the payments. Okay, when we receive payments in 2017, 10 million, and 2013, 18 or 30 millions. So those are time we need to pay tax. Okay, so so that's why from this situation you can see we have two kind of differences. One is permanent, one is temporary, right? And then that's why you can see this is the taxable income. 100 should be the taxable income. Okay, that makes sense, everyone? How to get a taxable income? Okay, if you don't have questions, then let me continue. Okay, so again, if you look at this situation like 145 minus 5, right? So we exclude 5, exclude the 40s, then you should get a taxable income 100. Okay, so this is taxable income, and then for this year, for this 2016, taxable income is 100. Now tax rate is 40%. 100 times 40%. That's how we get this tax is due this year, right? So that's the 40 millions. 40 million should be income tax payable, right? Let me go to journals here, right? So 40 millions is income tax payable. Okay, it's a 40 millions. Okay, that's how we get the 40 million. And then how about these the temporary differences? Remember this difference, municipal bond interest is a permanent. Okay, you won't have, you don't pay tax this year, you will not pay tax in the future. Okay, so this is not a part of the future taxable amounts. Okay, because this is a permanent differences. You will never pay tax on this 5. Okay, so this 5 is not future taxable amount. Which one is the future taxable amount? It's this installment sales, right? Remember, installment sales, we don't pay tax. Okay, we recognize the revenue, but we don't pay tax this year. We pay tax when we collect the payments, right? We collect payment 10, so you pay tax on that, right? And you collect payment 30s, you pay tax on that. Okay, so total future taxable amount is 40, right? So total here is the 40s. Okay, so again, 5 is not part of that future taxable amount. Okay, because this is a permanent difference. We would never pay tax on 5. Okay, so 40 is the future taxable amount, right? In the future, we pay tax on the 40s, and let's say tax rate is 40%. 40 times 40%, you got the 16, right? 16 should be the balance in this account, right? Deferred tax liability. So let's assume the beginning balance is 0. So how to make it become 16? You need to credit 16, right? That's how we get this credit, okay? 16 to deferred tax liabilities. So then to write the journals, last item will be the income tax expense, okay, which is the total in this case. Make sense, everyone, about this? Any question so far? You guys good? Okay, you guys good, right? Okay. So here we talk about the effective tax rate. Okay, effective tax rate. So the tax rate, if you want to include that the 5 millions, okay, municipal bonds, right? So municipal bond interest, okay. So if you want to include that, the effective tax rate will be, this one is total income for us. Pre-tax income is 145, right? So then total tax here, right? 56. Okay, income tax expenses 56. Okay, so 56 divided by 145. So then this is what? This is called the effective tax rate. Okay, this is the tax we're gonna pay. Okay, but you know, um, if you want to exclude that 5 millions, the investment, okay, so if you don't, in other words, if you don't invest that 5 millions, okay, so then our effective tax rate will be 40%. Okay, so this just show you when we invest in that municipal bond interest, municipal bonds, so we receive the interest is tax free. That's going to decrease our total tax, right? Going to decrease our total effective tax rate. Oh wait, any questions at this moment? Looks good. Yeah, that's what we talk about the permanent differences. Okay, permanent differences. So this is the permanent differences is permanent. Okay, so it's that's like that situation municipal bonds interest on tax-free municipal bond will be tax-free forever. Okay, they're going to be permanent differences, not like a temporary. There's the initial difference, then they're going to reverse right in the future. Okay. So this is the temporary differences. Okay, temporary differences is much easier than the permanent differences, right? So like this, you just exclude it, right? So just exclude it, and then that will not be the future taxable amounts. Okay, just exclude it to get the taxable income, to calculate taxable income. Okay, so that's the permanent differences. So now we have two kinds of differences, right? Permanent, temporary. And temporary differences, you have two situations, right? So either pre-tax account income is greater than taxable income, or pre-tax income is less than taxable income. Okay, that results one the liabilities, or another one is assets. Okay, so that was our first topic. Okay, so our second topic is the tax rate. Okay, so what if the tax rate is different? So far, you can see we assume our current year tax rate and the future tax rate is always the same. Okay, so what if we have a different tax rate? Okay, so let's look at this example. Okay. So this is still the previous example, right? So we had that municipal bond interest, remember municipal bond interest, permanent differences, okay? And then we have this installment income, right? $40 million, okay? Um, the So we're still gonna calculate the taxable income 100, right? So 100 times 40%, you got the 40. 40 should be the income tax payable, right? So which is credit, okay? And then you want to figure out what is the total future taxable amount, right? We already know future taxable amount is 10 and the 30s, right? In 2017, you're gonna pay tax on 10. 2018, you're gonna pay tax on 30 millions, okay? So total future taxable amount is 40s. But here is different, okay? So the tax rate for 2017 is still 40%, but tax rate on 2018 will be 35%. So then we have to calculate our deferred tax liabilities separately, okay? So like a year by year, okay? Not the total, not like a previous example, right? So we calculate total pre-tax future taxable amount. So now you have to calculate year by year, okay? For the 2017, what do you see here? 2017, we will pay tax on 10, right? So remember, our tax rate is 40%. So 40% of the tax of 10 will be what? Will be 4, right? 4 should be our tax obligation, right? So how about 2018? 2018, now the 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 tax we need to pay is on the 30s, right? So then tax rate is 35%. So 35% times 30%, 30 millions, so you got 10.5. Okay, so that is our tax obligations. Okay, so we add those two together, so that's how we get 14.5. So 14.5 should be our total tax liabilities. Okay, we call it deferred tax liability. So now let's look at this T account. It should be 14.5, right? But it was zero. How to make it become 14.5? We need to credit 14.5. That's how we get this credit 14.5, right? In journals. And then, of course, the last item, the journal is always the income tax expense. Okay, so which is here, which is the balance. Okay, that makes sense, everyone? You see the future, here we have 2 years, right, for the reversal years. Okay, so the 2 years here, so these 2 years are different. We have a different tax rate. Then we have to calculate our tax liabilities separately. Then you add them together. Okay. Question. Okay, so if not, then we may have some issues like a uh, change in tax rate. Okay, so changes in the tax rates. So like what happened, like we have this example, right? A couple of years ago, so our federal government changed the tax rate for corporation, right? So decrease the tax rate for corporation to 20%, right? So so that's the change, okay, in the tax rate. So if you have change in tax rate, so then you want to change that your liabilities as well. Okay, your liability also gonna be changed. So this is the example. Let's continue to that example. Okay, let's continue to this example. Okay, so this is we still under this example. We have this temporary differences in installment income situation. Right, this is year 2016. Right. So then how about 2017? So we have this 2016, we predict, right? So this is what we have. We have 2017 tax rate will be 40%, and 2018 tax rate will be 35%. Okay, so our liability is calculated based on our prediction, okay, on those two tax rates. Okay, so let's say, how about 2017? Let's look at 2017. Okay, so this is the current year 2017, right? 2017, let's say pre-tax accounting income to 100. Okay, and then remember the temporary differences. Now we need to pay tax on 10, right? Remember that 10, we collect payments, right? $10 million, right, from that installment sales. Now we need to pay tax on 10. So that's why our taxable income is 110, right? You're 100 plus 10. Okay, you need to pay more tax, right? So in the 2016, you paid less tax, right? So now you need to pay more because 10 was the future taxable amount, right? For if you're from 2016, now it's a taxable amount. Okay, so so total is 110. Then tax rate is 40%. 110 times 40%. That's how we get this 44, right? 44 should be the income tax payable, right? Income tax payable. Journals here, right? Income tax payable. We should credit 44. Okay. Then how about the future taxable amount? Future taxable amount is what? Remember the initial differences is 40s, right? So now the difference is going to decrease by 10. So you have a 30, right? $30 million is the future taxable amount. You're going to pay tax when you collect $30 million in 2018, right? So that is the future taxable amount. So future tax rate, it's just like what we predict in 2016. Its tax rate is 35%, right? So then 30 times 35%. So that's how we got to 10.5. So 10.5 should be the balance, right, in this liability accounts, right, deferred tax liability. But remember, at the beginning of the year was 14.5, right? It comes from the previous year, 2016. So how to make it become 10.5? We need to debit 4, right? When you debit 4 to this accounts, that's why we debit 4 to this accounts in the journals. And then the last item in the journals is income tax expense, which is the balance in this journal. Okay. Looks good. Okay. So what if, okay, what if we have a tax rate change? Okay. What if this year, 2017, just like the year we had, what was the years? The years we had that 2018, right? Actually, so that year, by I mean December of that year, so the president announced, right? So he said, we're gonna cut the tax rate, right, for the corporation, from 35% to 20%, right? So now government made the announcement. So we said, now the future tax rate, let's say, is 30% instead of 35%. Okay, so in the year of 2017, we realized the tax rate in the 2018 will be 30%. Okay, so then what are you gonna do? Then you're gonna use 30%, right, to calculate the future taxable uh, future future tax, right? So tax obligations. So we're still going to calculate this is taxable income, right? So times 40%, you got 44. 44 still the income tax payable, right? 44. But for the future taxable amount, it's 30, right? So now 30, our tax liability, tax obligation should be 30 times 30%. So that's how we get 9. So this deferred tax liability should have balance 9. Okay, that should be our tax liabilities, okay, our tax obligations. It was 14.5 from 2016, right? So now how to make it become 9? So we need to debit 5.5. That's we debit 5.5 in these journals. And then we always gonna last item, right? So income tax expense is always the balance. Okay, in this case, it shows you when tax rate change, then you need to change accordingly. Okay, so you change that because tax rate change, now your tax obligation gonna change as well. Um, any questions on that? And then this is just like because we changed from 35 to 30% in our situation, right? So what you can do is you can stay with originally, okay? So this is what at 35%. This is original journal, and then you add, right? You add additional journals, okay? So this is additional journal. You combine those two, then will be the total, okay? So you add this. This is additional journals, right? This is like adjusting journals. So because 35 from 35 to 30%, right? You adjust like 5%, right? 5% of that the 30 millions, right? So 30 million is the future taxable amount, right? 5 times 5%. So that adjustment should be 1.5. Okay. So you just make this adjusting journals because the tax rate change is decreased from 35 to 30. That's why our tax obligation is decreased by 1.5. So we have less obligation, right? Because we're gonna pay less tax because tax rate is decreased by 5%. Okay, so that's why our liability is going to decrease by 1.5. You need to debit, right? And then our income, again, income tax expenses is always the item, okay, at the last item when you write the journals, okay? So you're going to credit income tax expenses. In this case, this is the second approach, right? So you stay with the original. This journal is the original journal. We assume this is 35%, and now you add this adjusting, right? This is the adjustment. Okay, so these two together. So if you add this, this is the second method, right? So no matter what, it's good, right? So this is the first method here we talk about, right? So you just do one journals, okay? or you can do 2 journals, okay? But if you add these two, it's gonna be the same with the previous slides. Okay. So this is the tax rate change situation. Any questions so far?
Can you go back to the last slide for?
Oh, okay, okay. This one?
Yeah, that's good. Thank you.
Question on this?
I just wanted to see what the.
Oh, okay, okay. You know, the PowerPoint is online, right? It's on Canvas. Okay, you can always download the PowerPoints.
Thank you.
You're welcome. Any question at this moment before we do the exercise? I think we can just do a little exercise to make sure you guys are okay with this. Okay. Let me see. Where's that one? No. Okay. Yeah, let's work on this 16-17. This question. Yeah, 16-17. Okay, let's work on this question. 6-17. Let's just practice this part. Okay?